We are proud to announce the 2019 Palisade Global Hard Asset Conference, taking place on Jackal Island from May 16th to May 20th. Speakers confirmed include legendary mining investor Paul Matizek, former hedge fund manager Mike Alkin, and resource managing partner Matt Geiger, plus many more to be announced. Sign up now for more details and to be included in our special guest list. Join us in Jackal Island to become part of a growing number of investors who are ready to take advantage of a coming resource boom. Welcome back to another episode of Palisade Radio. I'm your guest host, Kareb Mamutlu, and on today's show we have returning guest Jaime Carrasco from Canaccord Genuity. How are you today, Jaime?
I'm doing well. Thanks for having me back right at the end of the year, and what a year.
No problem. The volatility in the Dow Jones and the S&P 500 has made many investors cautious over what 2019 will bring. However, gold has reacted positively to this so far. Will this strength in gold continue throughout 2019, Jaime? And what does this tell you about gold going forward?
I tend to be a little bit more contrarian than the average investor or advisor out there, and I've been saying to people for quite a while that to me, the markets have been manipulated, all markets. I've been working under the assumptions that the equity markets have been pushed up. Same thing with the real estate market, the bond market, with all of this money that was printed. However, some markets have been held down, and more importantly, the market I'm talking about is gold and silver, mostly because they are the systemic risk alarm of the system. And, would people be as willing to jump into the Dow at 25,000 if gold was anywhere near 3,000 to 5,000 or anywhere higher than where it is right now? No, they wouldn't. They would be questioning it, right? And how I see things is just a debt-driven facade. Because of that, if you follow back some of the other interviews halfway through the year, at the beginning of the year, started to advise in caution because I said as interest rates start to go up, the mechanics of that manipulation, cheap interest rates, are going to start to have negative effects on the things that have been manipulated, both up and down, and we should start to see a reversal to where their true value should be. Now, I think that is beginning to happen. I think that all of this stimulation that central banks have put into the system now is being taken away, and because of that, we're starting to see the volatility as interest rates start rising. In that environment, I have been advising that clients have precious metals positions because they are the systemic risk alarm or hedge for more than 4,000 years, and I don't think it's going to be any different this time. And it's definitely starting to show that way, as though the mechanics of price discovery are finally starting to kick into these markets. And, to some extent, I'd rather be buying the one market that everybody's shunning versus the ones that everybody's entering or has been entering for a while. So to me, I think for 2019, we are in for not, I wouldn't use, I love the way that the Chinese write the word danger, because they use two symbols, the symbol for crisis and the symbol for opportunity. And I think that's the year ahead that we're going to have a place to make some money if you can position yourself in the areas where the money will be filtering to as it seeks safety because of rising interest rates and because of higher volatility. Now, having said that, one of the things that people have to be aware is that everybody, even Trump has been going on about the Fed. Why are they raising rates? Well, the Fed has to raise rates. They're stuck between a rock and a hard place because the next recession is coming. Now, when the next recession hits, they haven't raised rates enough to really give them any buffer, so they have to go there. So I think the volatility going forward will continue to enter into the markets, and I think it's mostly going to be driven by interest rates. And because of that, it's the bond market, it's the equity markets, but the safety valve of that is the precious metals market. And I think I will continue to advise at least a 15% hold or consideration in that sector. I know it was a long-winded answer, but it was a recap of the whole year.
No, very good, very good. In a previous interview, you also talked about the 10-year yield. What are your thoughts on that?
Everybody's talking about an inversion of the yield curve. I don't know. I think that we'd don't necessarily need an inversion of the yield curve when you look at some of the negative economic indicators that are out there. Look at the housing index. It's already starting to suffer throughout the world. Bottom line is I continue to see more and more systemic risks throughout the system, right? Be it real estate, look at what's going on with Sears, what's going on with pension funds, what's going on in the geopolitical factors, which I think are more important. I think when I'm looking at the geopolitical puzzle, how that's shaping up, I think that's where people should be paying attention because all of those go above the markets, and I think they're going to affect the global economy as a whole. I thought it was very interesting to see the last G20 meeting because if you look at the announcements that came out after that, right, you had Qatar saying that they're stepping out of OPEC January 1. You had the Europeans coming out and saying that they need to find another currency to start buying energy with, apart from the U.S. dollar, so they can see it in the euro. To me, those are clear signals that something's afoot with the petrodollar, something that I've been expecting for all year long as the petro yuan kicked in, as China continued to acquire energy outside of the U.S. dollar. I think that when I look at the chess game from above, what Trump has done with the G20 is he's been given a warning that the Saudis are pretty much going to walk away from the petrodollar, and there goes the currency, the monetary currency reserve that we've been working on for quite a while, right? And to me, that is a more important change than everything else, the markets and all that, because if the world walks away from the dollar, it'll affect everything, right? And one of the things that nobody looks at, and when I talk to my colleagues, they're all, very well versed with individual companies, but nobody's looking at what's happening within the currencies themselves. Because here's the problem. The stock market could go up, but if the currency's crashing at a faster rate, nobody's making any money, right? And so the currency, I think, and tied to interest rates is really the big picture for 2019, and I think a lot of changes afoot. The signals are there. The Chinese are signaling it. The Asians, the Middle East is definitely signaling it with what's happening with Syria. They're pulling out of all of these places. And all of these wars in the Middle East was about the control of oil in the sale of energy in U.S. dollars. Right now, Trump realizes that he doesn't need Middle Eastern countries to sell oil in U.S. dollars anymore because they're one of the biggest producers. They don't need to buy it. So there's a lot of factors that are in play that will affect both interest rates and the markets for 2019 that I think are not really being looked at by people on a realistic scale of what it entails going forward.
You've also mentioned, talking about systemic risk, you've mentioned Deutsche Bank in the past and their continued fall in their share price. So how important is Deutsche Bank to the financial system and to investor confidence in general?
Well, I think Deutsche Bank and a lot of the other financial institutions are going to be the test that comes now. Go back to 2008. Right? All we did was solve a debt problem with more debt. We bailed out a lot of the banks. Have they really cleanse their problems that they had in 2008? Are they better today than they were in 2008? That I think is the $64,000 question. What will happen to the banking system when everything, if everything does blow up in a 2008 type of manner, which I would expect at some point, right? Deutsche Bank on its own, I think there's a very big difference in that Trump will not bail them out. Right, it won't be like 2008 where the Fed had to step in and bail out a lot of European banks because of the systemic connection between all of the banks. If we look at Deutsche Bank on its own, well, the German government has been trying to sell it to Commerzbank. Commerzbank doesn't really want it. I don't think it really matters. I think they have to take it no matter what because this is an institution that's carrying more than $60 trillion in credit derivative swaps, right, tied to the Italian mess. A lot of that is tied to the Italian mess and a lot of the fixed income problems. So Deutsche Bank continues to be the number one systemic risk, in my opinion, within the system of something that could seriously blow up. And it's not the only one, but it's definitely one of the bigger ones because of the credit issues. Now, within that, any kind of dislocation to the European experiment will affect Deutsche Bank. And because of that, again, when you start to add up all the systemic risks that are in the system, that being one of the bigger ones, I think people should be more cautious than than I think they are being. The other thing is, look at the move that we had on Boxing Day. Canadian markets were closed. The markets were up 1,000 points. Well, you have to understand that nobody was working. Who was buying? Whose money was being used to support the market on that day, right? I'm sure that there wasn't many souls on Bay Street or Wall Street on that day, and most of that trading was computers being done with Fed money, right? The Plunge protection team, which Mnuchin had called on Christmas Eve, which, by the way, it's another big alarm for me. You don't call that kind of meeting right before on Christmas Eve, right? So there is risk in the system, and that I think is again, I think it would be silly to negate those and not to be raising some cash and taking a more cautious stand within to the markets.
You focus your attention on the gold producers as a leverage play on gold. So can you give us a few reasons why you like the producers and what criteria do you look for when investing in one?
Okay, that's a good question. The reason being is that I see gold no different than cash. Physical gold, physical silver, to me, is no different than if I'm sitting in cash, and clients should be holding U.S. dollars, euros, just to diversify their cash content. Gold and silver should be part of that. The speculation itself is in the miners. To some extent, I see that as a replay of history. If we look at history, the last time we went through a similar setup as we're going through right now, which is a currency reserve shift because of too much debt, it was in the 30s. Right, and the prime beneficiary of that adjustment that occurred in 1933 when Roosevelt finally pulls the plug on all the debt and raises gold from $7 to $35. We know the history of that. I've spoken about it in the past. Well, the prime beneficiary were the producers because prior to the adjustment, they're still producing at $5, selling at $7. After the adjustment, they're producing at $5, but now selling at $35. So they benefited greatly from enhanced earning growth, reserves on the ground, and massive dividends. So I think that will replay. However, there's certain risks that people should be looking at and assessing. So within the selection of companies that I buy, I want to make sure that, first of all, they have great management in good geographical areas with very little geopolitical risk, low cost of production, and high reserves on the ground, because that'll give us the leverage. Right now, you have companies like Agnico Eagle with millions of ounces on the ground at zero value because the cost of production globally for the industry is about $1,300. So below $1,300, it doesn't matter that they're producing at $600. Those reserves have zero value. Above $1,300, they'll start to have value, and that's really when you see the leverage kick into these companies. It's nice to see that the stock selection's working, and we had an amazing quarter with a lot of the companies that I follow. It's one of my juniors actually bought out a company. Not many juniors were buying in this environment. Another one got bought. Everybody has had excellent financials results over the quarter, and they're all catching the eye of some very big players. So it kind of shows that the process is working in terms of selection. But if you stick to those four criteria in selecting companies, I think you're going to be safe in choosing some good one. On top of that, you want to have a good company that is a research team working behind you, so you don't have to do it. And I'm so happy to be at Canaccord because we have one of the top teams, and they're always coming out with really good ideas in the sector, and where I can tune up the quiver of companies that I have within the portfolio.
We're at the end of 2018, so has anything surprised you throughout this year within your research or analysis?
What has surprised me is people ambivalence as to how these markets have gone up and where they are. It surprises me that investors just don't learn, right? I see it no different than in the year 2000 when everybody was running in to buy Nortel. Everybody had to own Nortel before it fell out of bed. I'm seeing the same thing within the markets today, that everybody, the calls for this market is okay, and, buy the dip, get back in, maintain your positions. I don't know. I think that there's way, way greater risk because, again, I've been working under the assumption that in 2008, you can't solve that problem with more debt. Sooner or later, that solution is going to come to roost because they're going to have to raise rates. We can't control interest rates at zero forever. And so now we're on the other side of that, and to me, everything I see is more, prepare for the worst, but prepare to be where the assets are going to go to. So that's where you're going to benefit. And one of the problems with that scenario as well is that cash would be of caution. One of the things that has surprised me, again, throughout this year, and especially coming into the third and fourth quarter, is that I keep hearing more and more the word liquidity problems. Well, liquidity problems are exactly what were the catalyst for the big issues in 2008, when the system needs cash because there's way more debt than cash, especially as all of this debt starts to get redeemed, right? It's the liquidity, right? And that's why the more liquidity alarms that we hear, the more caution people should be taking, because I don't think that when this storm hits, it's going to be like 2008. I think they're quite ready. They know what's coming, and we might just get a system shutdown. So I think it's important to be prepared with positions in place, raise cash, and be ready for whatever might come through 2018. Also, I think that the politics in the U.S. are just going to get worse and more vile. Like, look at what's going on right now. This fight, the government shut down. He wants his wall. The troops are coming out. Somebody doesn't want the troops. So we're getting more polarization, more dislocation within the political system. That won't be good for the U.S., right? And that's only going to get worse. So that's another thing that I would be very cautious of. The big trends, I tend to look at the bigger trends from up above, and to me, the big issues right now is the level of de-dollarization that is happening throughout the world. The fact that finally gold and silver look as though they're finally starting to break out, which is inevitable. At some point, they're going to have to go. The positioning by the banks, by the bullion banks, they've covered a lot of those shorts, and they seem to be taking the long side finally, which will make, I think they know that sooner or later the mechanics by which they've been suppressing, manipulating the price. You might as well use the word, because now it's out in the open that they have been manipulating the price. Are not going to work forever, and they want to take the long side of the trade. So it's nice to see all these changes occurring. But again, I would be very cautious. I would advise caution to investors, because these are issues that most are not going to see coming again, and they're bigger than '08.
As a final question, is there anything else you'd like to share concerning the markets or for commodities in general? Anything on your mind?
Yeah, we just I've kind of put the phone away for the holidays, because we just had an awesome Christmas. We finally got some good news on the medical front with our son. I would like to say to everybody that there's nothing more important than your health. That's a lesson that my wife and I learned this year, and it was a rather tough year because of it. Now we have some really good news going forward. But I would like to wish everybody the best of health going forward as we go into this. Prepare accordingly for the financials and the risks in the market, but make sure that health is the most important thing. And that's really the one takeaway I would like to give everybody. And be ready be nimble for the year ahead. I think that it's going to be a changing year, in that I don't think people foresee what comes next. I think that there's a high probability that we might get a complete paradigm shift in the geopolitical structure of the world going forward, and to some extent, Trump is accelerating those changes. One more thing that I would like to be. It's funny, over the holidays I was reading up on an interesting book called The Wizard of Oz, and I was reading about how it's an allegory for how once, before it was made into a movie, when it came out in the early 1900s, it was an allegory for staying within a gold standard. That's why Follow the Yellow Brick Road. It's funny that through allegories we usually come up with remembrances of the past, of the mistakes that we've made. I think one of the mistakes that we have made is the fact that we've gone too far, too long on a fiat currency system, and now these promises can't be met, right? That's why, to some extent, the gold standards have always been around for more than 4,000 years as a monetary system. And I think to some extent, if you look at what the Chinese want, what they've been asking for, is the return of some kind of harder money, not just a fiat system, because they want something that'll work for a long time. They understand that what's the point of having another fiat system if it's only going to work for 40, 50 years, right? They think in very long terms and look at the messes that we've ended up with. So, again, I think for the year ahead, it's going to be a trying year in that we're going to be changing tack, and I would advise investors to think forward and prepare for a new direction before they are forced to shift gears.
Excellent. Well, thank you very much, Jaime, and I'm sure we'll have you back on the show again very soon for an update.
Well, I thank you for having me. It's been a great year, and I always enjoy chatting with you guys and your listeners. And happy 2019 to everybody.
And to you. Thank you very much.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?